Imagine having more money saved than your neighbors while earning less than half of what they do. No lucky investment, no inheritance check, no financial advisor on speed dial. Just a quiet family, a kitchen table, and a handful of habits that almost nobody remembers anymore. It's 1948. The war is finally over, but for millions of American families, the financial fear hasn't gone anywhere. Prices are climbing, wages are struggling to keep up, and in a small house on the edge of a quiet Ohio neighborhood, a family is sitting around the kitchen table trying to figure out what comes next. Their name was Calloway, Walter and Ruth, 2 kids, 1 income. From the outside, they looked like every other family on the block. Same modest street, same worn furniture, same worries about grocery prices and heating costs. But something was different about the way they handled money, something quiet, almost invisible to everyone around them. Because somehow the Calloways were the only family on that entire block who never panicked, never scrambled for cash at the end of the month, never knocked on a neighbor's door asking for a short-term loan. Their methods would look almost strange by today's standards, almost backwards. Some people who heard about their habits called them obsessive, old-fashioned, even a little paranoid. But what happened next would challenge everything we believe about saving money today. Their real story didn't begin with wealth. It began with a decision nobody noticed. The invisible savings jar. Walter Calloway was not a complicated man. He worked at a machine parts factory on the east side of town, punched in at 7, punched out at 4, brought home a modest paycheck every Friday afternoon in a small brown envelope. And every Friday, before he did anything else, before he paid a single bill, before Ruth bought groceries, before the kids got their 10-cent allowance, Walter did something strange. He took a portion of that cash and he hid it. Not in a bank account, not in a jar on the mantel where everyone could see it. He hid it somewhere out of sight, somewhere that required a deliberate decision to go and get it. Ruth thought he was being overly cautious at first, but Walter had a theory. A simple one, almost embarrassingly simple. He believed that money you can see, you will spend. Money you cannot see, you forget you have. And forgetting, he argued, was the whole point. This wasn't about discipline. Walter was the first to admit he didn't have iron willpower. He liked a cold beer on Saturday. He liked taking the kids to a ball game when he could afford it. He was not a monk. But he understood something that most people around him never figured out. The brain doesn't save money through willpower. It saves money through distance. When cash sits in your wallet, your brain registers it as available, as options, as possibility. And possibility has a way of becoming purchase very quickly. But when that same money is tucked away somewhere inconvenient, somewhere you'd have to make a real effort to reach, the brain stops counting it, stops factoring it into your daily decisions. It becomes invisible, and invisible money is safe money. Today, we call this concept out of sight, out of mind. Behavioral economists have built entire careers studying exactly what Walter figured out, sitting at his kitchen table in 1948. Every time you check your banking app and see your full balance, your brain recalibrates what feels normal to spend. The number you see becomes your permission slip. Walter never gave himself that permission slip. He was saving money without ever feeling like he was saving at all. But the strangest part of this story was still coming, because hiding the money was only the beginning. The 48-hour cooling rule. It was a Tuesday evening in late October when Ruth Calloway saw the coat. It was hanging in the window of Harmon's department store on Main Street. Dark green wool, double-breasted, Exactly the kind of coat that made you feel like a different person just looking at it. She had been stretching her winter coat for 3 seasons already. The lining was fraying, the buttons didn't all match anymore. And this coat in the window was not even that expensive. Not really. She stood there for a long moment, did the math in her head, told herself they could manage it. Then she walked home. Not because she couldn't afford it, not because Walter would have said no. She walked home because of a rule the Callaways had made together years earlier. A rule so simple it almost sounds like a joke. If you want to buy something that isn't on the list, you wait 48 hours. That's it. Just wait. No elaborate system, no committee, no guilt. Just time. Because Ruth and Walter had learned through experience that most purchases feel urgent in the moment and unnecessary 2 days later. The wanting doesn't change the need, it just changes the feeling. Wartime had taught them that. During the war years, you didn't buy what you wanted, you bought what you needed, and your needs turned out to be far fewer than you'd ever imagined. The scarcity mindset they developed during those years became a kind of filter, a pause between impulse and action. When Ruth went back to look at that coat 48 hours later, she still liked it, but the urgency was gone. The emotional charge had faded. She could see it clearly now for what it was, a want dressed up as a need. She didn't buy the coat. She bought fabric the following month and made one herself for a fraction of the price, and she wore that coat for 11 years. Today, the entire architecture of modern shopping is designed to eliminate your 48-hour window. One-click buying, limited-time offers, flash sales, the countdown timer on your screen. Every one of those tools exists to shrink the space between impulse and purchase down to 0. Walter and Ruth stretched that space deliberately, and it saved them hundreds of dollars a year without them ever feeling deprived. But a much bigger spending trap was still waiting for them. The cash-only psychology. There's a moment that Walter described years later to his oldest son. He was standing at the hardware store, holding a hand drill he didn't strictly need. It was a good one, well made, and he wanted it. He counted out the bills from his wallet one by one, placed them on the counter, watched them leave his hand, and he said it felt like something small dying inside him. That feeling, he told his son, is the most honest financial feedback you will ever get in your life. Never ignore it. The Callaways used cash for everything: groceries, clothing, hardware, entertainment. If they didn't have the physical bills to hand over, they didn't buy the thing. This wasn't ideology, it wasn't distrust of banks, it was psychology. Because Walter had noticed something. When he used credit or wrote a check, the spending felt abstract, removed, like moving numbers on paper. There was no weight to it, no texture, no moment of real loss. But cash had weight, cash had texture. Handing over a $5 bill felt fundamentally different from making a mark in a ledger. And that feeling, that small sting of loss, was doing something important. It was keeping him honest, keeping the transaction real in his body, not just in his head. Neuroscientists, decades later, would confirm exactly what Walter sensed. Paying with physical cash activates the same regions of the brain associated with physical pain. It is literally uncomfortable to spend cash. Your brain resists it. Paying with a card, or today with a tap of your phone, produces almost no similar response. The transaction is frictionless, which sounds like a feature. But friction, it turns out, was protecting you. Today, the average American spends somewhere between 12 and 18% more when paying digitally versus paying with cash. That gap is not accidental, it is engineered. Walter Callaway never read a neuroscience paper in his life, but he understood in his gut what researchers would spend millions of dollars to prove. Spending should feel like something. Then they discovered a system that controlled every dollar before it had a chance to disappear.
The envelope system. The envelopes appeared on the first day of every month. Ruth would sit at the kitchen table right after breakfast with a stack of plain white envelopes, a pen, and the cash Walter had brought home. She would write one word on the front of each envelope: groceries, utilities, clothing, school, doctor, emergencies, church. Then she would count the money carefully and distribute it. Each envelope received its designated amount, not a dollar more, not a dollar less. And once an envelope was empty, it was empty. There was no borrowing from groceries to cover clothing. There was no shuffling funds around when things got tight. If the clothing envelope ran out before the end of the month, you wore what you had. If the grocery envelope was running thin by the third week, you got creative with what was in the pantry. The envelope wasn't a suggestion, it was a wall. One November, the furnace needed a repair they hadn't fully anticipated. The utilities envelope covered part of it. The emergencies envelope covered the rest. There was a tense conversation at the kitchen table that evening. Numbers on a notepad. Quiet voices so the kids wouldn't worry. But they got through it without borrowing, without panic, because the system had prepared them even for the things they hadn't specifically prepared for. What the envelope system did, at its core, was turn an abstract budget into a physical reality. You could hold the grocery envelope in your hand and feel how much was left. There was no logging in to an app, no scrolling through a spreadsheet. The envelope told you the truth immediately and without argument. Today, financial technology has given us 1,000 ways to track spending: apps, dashboards, alerts, auto-categorization, and somehow Americans are saving less than at almost any point in modern history. Because tracking spending and feeling spending are two entirely different things. Ruth Calloway felt every dollar. She held it, she counted it, she allocated it before the month could make its own decisions about where it went. The month never won. Then something unexpected broke.
It was a Saturday morning when the kitchen faucet started leaking. Not gushing, just a slow, persistent drip that tapped against the basin like a small and patient reminder that things don't last forever. Walter looked at it, Ruth looked at it, and then Walter went to the garage. He came back 20 minutes later with a washer, a wrench, and a patience that his youngest daughter found baffling. She asked him why he didn't just buy a new faucet. Walter thought about the question for a moment. Then he said, "Because this one still works." The fix took 40 minutes, cost 11 cents for the replacement washer, and that faucet ran without a drip for another 9 years. The Calloway household operated on a principle so basic that it barely needs a name. If it's broken, fix it. If it's wearing out, maintain it. Replacement is the last resort, not the first response. This was not stubbornness, it was not poverty. It was a deeply held belief that the things you owned had value worth protecting, that craftsmanship deserved respect, that the labor and materials that went into building something were not disposable just because something newer existed.
Walter repaired shoes. He patched clothing. He recaned a chair that 3 different neighbors told him to throw away. He sharpened knives that a hardware store salesman said were past saving. He kept a box in the garage that he called the fixer box, full of small parts, spare screws, replacement belts, and salvaged components from things that had finally given out. He almost never needed to buy new. Today, we live in an age of planned obsolescence. Products are designed to fail. Software updates are designed to slow down older devices. Warranties are calibrated to expire just ahead of the problems they might have covered. The message woven into modern consumer culture is simple and relentless. It's time for a new one. Walter Calloway heard that message too, and he quietly disagreed. Because every time he fixed something instead of replacing it, he was keeping money in the envelope system where it belonged. He was refusing to let the market make his financial decisions for him. But the family's greatest financial breakthrough came from something even stranger than fixing a leaky faucet.
It started with a pie. Ruth had made 2 apple pies on a Sunday afternoon in the fall of 1949. The kitchen smelled incredible. She brought one next door to the Hendersons because that's what you did. Because Dorothy Henderson's husband, Bill, was a plumber. 2 weeks later, Walter mentioned to Bill that the bathroom pipes were making a noise he didn't like. Bill came over on a Saturday afternoon and fixed it in an hour. Wouldn't hear of being paid. Said the pie was more than enough. That was the beginning of something the Calloways didn't have a name for, but relied on quietly for years. An informal network of exchange. Skills traded for skills. Labor swapped for labor. No cash changing hands, no receipts, no invoices. Their neighbor on the other side, a woman named Frances, had a garden that produced more vegetables than she could ever use. The Calloways had a truck. Sometimes Walter would make a run to pick up supplies for Frances when she needed them. She would appear at their door with tomatoes, beans, squash, and once, memorably, an enormous bag of potatoes that lasted the family through most of December. There was a man 2 streets over who cut hair, a woman on the corner who could alter clothing to fit perfectly, a retired school teacher who tutored the Calloway children in mathematics in exchange for Ruth's help with her correspondence. None of this was organized, none of it was formal. It was simply neighbors paying attention to what each other needed and offering what they had. In a year when money was tight across the whole neighborhood, the barter circle quietly subsidized everyone who participated in it. Needs were met, skills were honored, cash stayed in envelopes where it belonged. Today, the subscription economy has replaced much of what communities used to do for each other. You pay monthly for things your grandmother would have borrowed from next door. You hire services your grandfather would have traded for over a handshake. The Calloways understood that money was one way to get things done, but it was never the only way. Yet one final rule quietly powered everything else they did.